Okay, I want to finish this discussion on capital budgeting, and we'll change gears a little bit and look at how we address risk factors. We'll also look at some refinements, if you will, of making the capital budgeting decision. But so first, let's take a look at how we analyze the project itself. And what we want to do is address essentially what is a break-even analysis. We want to find the break-even of an input that would cause the net present value of the investment to be equal to zero. Now in Excel, you can use the solver function to find this value. You set the objective at the net present value equal to zero, and then you set the changing variable as the input variable in question. So in the comprehensive problem, this really doesn't work all that well because the variables are all allowed to change every time you make a change with each iteration. So it doesn't work well with that type of a problem, but it is simple enough if you have a simple spreadsheet, etc., just to find the number of units that you need to sell for net present value to equal zero if everything else is held the same. So if we look at the break-even units for this last project we've been talking about, right? Approximately 79,759 units would give you a break-even of net present value equal to zero. Wholesale price $232, cost of goods sold $138 per unit, and a cost of capital of 24.1% ultimately would give us, again, a net present value equal to zero. I mean, you also could do the level of sales where EBIT equals zero. Again, in our statements for a particular year, right? You plug in EBIT equal to zero as your objective, and then change the sales number to find out how much sales you need in order just to break even or have EBIT equal to zero. Another way to address risk in the capital budgeting sense is through something called sensitivity analysis. And sensitivity analysis is basically where we have a several, if you will, I guess I just want to call them, well, they're scenarios, right? You have a worst case, a best case, and an average case. So for our particular product that we've been talking about in this last example, these are the costs that we would find, or the units that we would find under a worst possible scenario. Units would be 8,000, price 16,000 or $16, labor cost $350, material cost $3, cost of financing 16%. Now what we can do is we can solve for net present value using these figures in our example, or we could find the net present value of the worst case scenario with everything else being constant except the units would be 8,000 units. So what we would end up with then is we end up with a table that we could create that would show us in general the values, the net present value for the products. And you can see if the price is real low, again, we might ultimately end up having a very low net present value if the price turns out to be that very low number, which I can't remember exactly what it is right now. But again, we would like to look at the potential of what the average net present value is. So in this case, we can plug these numbers into a spreadsheet and do an analysis much like is done with standalone risk. where we have to apply some probabilities. So if we say there's a 15% chance that the worst thing will happen, and the average and the best case being 50 and 35%, we can then calculate some statistics on this particular spreadsheet. So this spreadsheet is called the Capital Budgeting Project Risk Analysis. And as you can see, what we do is we plug in the net present values, and in this case, the A through E just represent the different variables. So A represents units, B's price, C's labor costs, etc. So the average net present value with asset A, which is the units number, is around $141,000. That's net present value. It's $157,000 if we're using price, $125,000 if we're using the labor cost, material costs are $127,000, and if you use the various cost of financing, it's $124,000. So we can see that the range here is somewhere from the mid 120,000s to the mid 150,000. So somewhere in that range is the net present value of this particular project. We can do lots of things for this, right? We can consider the effect on multiple things. So what if we say on average sales price would be $20, but at $20 we would only expect to sell 10,000 units. We then can calculate the net present value using these multiple assumptions of changing. We also can then look at what happens at different prices in different units. So maybe we say, hey, look, how many units do we have to sell at $8 to get the average net present value that we associated with $122,944? What's the average number of units we would have to sell, right? And of course, we find out what, at $20, that's our 10,000 units. That's where we started this whole example. So we can utilize a variety of Excel programs. We can use the solver program. We can use data tables. We can use data tables with two variables changing at the same time so that we can get a picture of how these the net present value changes as the variable values themselves change. So switching gears then, I'd like to talk about some refinements. The first thing we want to talk about is something called capital rationing. Now, firms often operate under conditions of what we refer to as capital rationing. The company says they're only going to spend X number of dollars. The challenge with that, though, is what happens if we have more good projects, more projects with positive net present values than what the company is willing to spend the money on. So we may miss out on some perfectly good projects that would increase the value of the company because management doesn't want to gather that much money. They're worried about the financing, if you will. So research has basically found that management, internally imposes these constraints to avoid what it deems as being excess levels of financing. Particularly, they're worried about debt. If we have this constraint, we then obviously have to utilize that information to find that group of projects that ultimately would provide the highest overall net present value or internal rate of return. So as a capital rationing project, we then have, here are our investments, A through F. Here's what would cost to do each one of these investments. Here's the internal rate of returns. Here's the present value of the inflows. So if you take 100,000 and you subtract 80,000, you get the net present value of 20,000. So then we also have a cost of capital of 10%, and we have a fixed budget of $250,000. So we're not going to be allowed to spend more than $250,000. So if you look here, here's 100, 200, there's 310, there's $460,000 worth of projects here. Some of them are good, one of them isn't, but all of them should increase the market value of the company with the exception of one project. So the first thing we can do is we can use what's referred to as the internal rate of return approach. There is a worksheet, it's called capital budgeting, capital rationing, and essentially you copy and paste your information, the projects, investments in the internal rate of returns, and you sort them by internal rate of return. So project B has the highest internal rate of return. When you sort these three columns, what happens is the cumulative assessment or investment changes. So if we do project B, we'll earn 20%, cost $70,000. If we do project C, now it's going to cost us $100,000, and it has 16%, that's greater than 10, so that's a good project. But now we spent $170,000. Likewise, if we do project E, we'll spend $230,000, but our limit is $250,000. And we know that 12 and 11%, the internal rate of returns for projects A and F, are greater than 10%. So we want to do these projects, but we have this constraint that's set by management. So again, this sets the limit, or the grouping, if you will, of how much money we're actually going to spend. And it tells us in the end how much the internal rate of return of our investments will be, and in the end, maybe what happens to the market value of the company. So we could also use the net present value approach, where we do the exact same thing, except now we are ranking by net present value. In this case, you can see that we would do projects C, B, and A. That would give us 3 projects with positive net present value, and we would spend exactly $250,000. Again, the challenge is there are 2 other projects that we could do that will increase the value of the company. But management has set these constraints. And I would go out on a limb and basically say that it's a pretty frequent way of doing business in most companies. Most companies constrain how much money they will actually go out and get. So what that ultimately does is adds another layer of pressure on the managers of a company to make sure, again, they want to get the money for doing their projects. They want to increase their company's asset size, or their division's asset size, so that they can obviously be more efficient, be more effective within the corporation. So using the internal rate of return approach, the reason it's kind of nice is if we rank the projects by internal rate of return and how much they cost, right? We can see we're going to spend roughly $460,000 on these projects. And we can see that B, C, E, A, and F all have internal rates of returns that's greater than 10%. They're all good projects. However, we are only allowed to spend $250,000. What do we do with this remainder here? Right? There's $20,000 that we're not going to spend. If A can be broken down into smaller projects, smaller components, maybe we could do a part of A. But in the end, we're missing out on doing projects that might increase the market value of the company. Another issue that we might have when we're looking at projects is to think about projects that are very similar. Maybe they're mutually exclusive, but for one reason or another, they are different in size, right? That is, here we have two devices. The first one, Project A, it's a cheaper device, but since it's cheaper, it's probably not as good. Maintenance is going to be harder. It'll wear out quicker. So it has 3 years of cash flows until this asset was no longer going to function. And Project B also has these cash flows, but it costs a little bit more. It's a little bit more expensive, but it's going to last longer. So how can we put these on an equal playing field? We want to use net present value, but Project B is going to be biased towards that project because it has more cash flows to add into the program. So there are typically two techniques we can use. One is called the replacement chain. We're going to repeat these projects until the sum of the chain, if you will, it begins and ends at the same date. Then we'll compute the net present value for all of the repeated projects. The equivalent annual cost method converts the net present value into an annuity that's received each year of the project's life. So here we have, again, it's called capital budgeting unequal lives. If you put in the net present value of the projects and their time frames, then you also put in their discount rates. Since they're mutually exclusive, they'll frequently have the same discount rate. We can see here that the annual net present value is $6,000 for Project A and $5,000 for Project B. So Project A is better than Project B, even though Project B has a higher net present value. Again, why is it higher? It's higher because it has an extra whole year of cash flows to add into this process. If we spread them out equally using the time value of money concepts, we see that roughly A is going to get more per year than B would. In addition, if you use the replacement chain, we would have to find the net present value for how many times we would do A and B. Now, this assumption of this particular analysis uses the number of years of A times B to talk about how many years there'll be. So we will actually do this project 3 times 4. We would do it 12 times. You would find the net present value of that. Ultimately, then we would end up getting $48,000 is the chain value for A, and $42,000 is the chain value for doing B. So again, these two techniques are used when we have two pretty much mutually exclusive projects that are different in their quality, which also makes them different in their lifespan. So speaking of lifespan, the last thing to talk about is something called abandonment analysis. What we're looking to solve for here is something called the engineering lifespan. In several of our examples, we've given projects a life. The project has a 6-year life. The project in this unequal life analysis, one of the projects is 3, one of the projects is 4. How did we come up with that? Well, the abandonment analysis helps us answer this question. It provides us with an answer which we would refer to as the engineering lifespan. That's the lifespan that's going to create the best result for the company. So if you look at this project, we need to estimate the salvage value of the project at each period of time. At the end of every year, we need to have a salvage value for a project. We then will use that number to calculate the techniques, the capital budgeting techniques throughout the series of years. So here we have a project. We spend $100,000. Here are the cash flows per year. Now we have assumed that if we do this project for just 1 year, So how would this work? We're going to spend $100,000 today. At the end of the year, we would get $50,000 from doing the project, and we would also get $85,000 from salvaging the assets that we purchased. So we get $100,000 today and $135,000 at the end of the year. What's the net present value for that? And of course, this calculates net present value modified into, it calculates the statistics for us. So in this case, net present value is $17,391. What about year 2? Well, we spend $100,000 today. Next year we get $50,000. The next year we get $50,000, but we'll also sell the assets at the end of the year for $65,000. So we what? Spend $100,000, make $50,000, make $115,000. The net present value for that is $30,435. And we continue this for the lifespan of the projects. Again, just to make the assumptions, make the cash flows a little bit easier to deal with, we're assuming that this last year's cash flow, $20,000, we're assuming that it includes the salvage value for the last year of the project. So again, if you look at this, we find out that the highest net present value is for year 4, right? All 5 years will give us a positive net present value, but doing it for 4 years will provide us with the highest net present value possible. If you look at internal rate of return, it says to only do the projects for 2 years. The modified internal rate of return says only do it for 1 year. Profitability index. If you look across the line, so profitability index and the net present value agree in this instance that this project has an optimal life of 4 years. So what we would do is we would assume that at the end of 4 years, we're going to have to replace this project. So we're going to have to do this over and over again, essentially every 4 years. So that's the end of the discussion on the fundamentals of capital budgeting.